The 10% penalty for touching your 401k before 59.5 is not the most expensive number in retirement math. Not even close. The real number is the gap between what your portfolio does in your first 2 years of withdrawals versus what it would have done if you'd started 6 months earlier or 6 months later. Research by retirement economist Wade Pfau found that approximately 77% of your portfolio's final 30-year outcome is determined by the returns of the first 10 years of withdrawals alone. 77% of 3 decades decided by a single window. And age 59 puts you dead center inside that window at the precise moment you feel the most safe. 3 separate systems are about to converge in this video that most retirement plans never model together. Sequence of returns risk hitting a portfolio at its peak size, a healthcare cost cliff that got materially steeper in 2026, and a psychological response pattern that causes even disciplined savers to make destructive decisions the instant the penalty disappears. I'm going to show you all 3, show you why they stack on each other, specifically around age 59, and give you the structural framework that lets you navigate the window cleanly. Not theory, numbers. Think of your retirement portfolio as a water tank. For 30 years, you've been filling it. Every paycheck, every employer match, every market return another gallon. At 59.5, the IRS finally opens the valve. You're allowed to start draining it without penalty. Here's the problem nobody models. You cannot control the water pressure in the pipe when you open that valve. If the market is down when you start withdrawing, every gallon you pull out is coming out at a discount. You're selling depleted shares to fund your life. And those gallons never refill because you've reset the water line at a permanently lower level. That's what I call the ratchet. Every withdrawal during a down market clicks the ratchet 1 notch lower, and there is no mechanism to click it back. A good market year doesn't undo the damage. It just slows the decline. This is why 59 is not a finish line. It's a pressure test. And the way most people approach it, by treating the penalty removal as the signal that they've arrived, is precisely what makes it dangerous. Now, before I show you why the first escalation of this problem is far more permanent than the penalty you just escaped, let me ask you a simple question. Of 2 investors who retire with the exact same amount of money, the same portfolio construction, the same average annual return over 18 years, which one runs out of money first? The answer tells you everything. Here's the setup. 2 investors. I'll call them Robert and Sandra. Both have $1 million in a balanced portfolio the day they retire. Both withdraw $50,000 per year, adjusted for inflation. Both earn the same average annual return over 18 years. The only difference is the order in which those returns arrive. Robert gets strong years early and weak years late. Sandra gets weak years early and strong years late. 18 years later, Robert still has money in the tank. Sandra ran out at year 17. Charles Schwab ran this exact scenario. Their research found that an investor who experiences a 15% portfolio drop in years 1 and 2 of retirement runs out of money decades before an investor who experiences that exact same 15% loss in years 10 and 11, even though both experienced identical total percentage losses over the full period. Because when you're draining the tank, at the same time the tank is shrinking, you're selling more shares to generate the same dollar amount, and those shares are permanently gone. They can't participate in the recovery. You've clicked the ratchet. This phenomenon has a name. Researchers Wade Pfau and Michael Kitzes formalized it as the retirement risk zone, a roughly 10-year window straddling your retirement transition date. 5 years before retirement, 5 years after. During this period, the combination of your portfolio being at its maximum absolute size, your withdrawals beginning, and your remaining time horizon shrinking creates what researchers describe as maximum vulnerability to sequence damage. A market downturn at 35 means you keep contributing, the market recovers, and 30 years later, it barely registers in your final number. The same downturn at 59 means you're selling your largest ever portfolio at reduced prices, with no new contributions coming in, to fund a life that could last another 30 years. You think the problem at 59 is the 10% penalty, but the penalty on a single bad withdrawal is nothing compared to what sequence risk does to the entire trajectory. Vanguard's research found that retirees who began withdrawals at major bear market onsets faced 81% portfolio depletion by the end of their planned retirement horizon. Compare that to 50% depletion for people who started during partial bear markets, 81 versus 50. That gap is not a rounding error. That is the difference between dying with a legacy and dying broke, caused not by investment strategy, but by timing alone. And JP Morgan put a specific behavioral number on what happens when this risk combines with a newly available account. Among near retirees who were already over 59 and a half, who had cleared the penalty threshold, 14%, withdrew an average of 30% of their retirement plan assets during volatile market years. The moment the handcuffs come off, 1 in 7 people immediately made the withdrawal that most damages their long-term picture. Not because they were reckless, because the behavioral pull of "I can finally access this" combined with market anxiety is nearly irresistible without a pre-built, pre-committed plan. Let me run the math with a real scenario, so this stops being abstract. You have $800,000 at 59. The market drops 20% in year 1. Your portfolio falls to $640,000. You also need to withdraw $40,000 to cover living expenses. So now you have $600,000. To return to your original $800,000, you need a 33% gain on what remains. But you're still withdrawing $40,000 every year. A neighbor who retired 6 months earlier in a flat market is sitting at $760,000 and simply needs normal growth. Same savings discipline, same 30 years of contributions, 6 months of timing difference, potentially irreconcilable outcomes for the rest of their lives. Stay with me, because this next part explains why the psychological trap at 59 is actually more dangerous than the math trap. In marathon running, there is a phenomenon called the death zone. It's not the final mile. It is mile 23, when the finish line first becomes visible. Runners who have held perfect form for 3 hours begin to relax. The brain perceives arrival. Form breaks down, pace slows, and that is exactly when legs cramp and knees blow out. Age 59 is the financial version of mile 23. You've been contributing for 3 decades. You've lived through market crashes in your 30s and your 40s and your early 50s, and every single time you held on and the market recovered, your brain has been conditioned by decades of successful experience to trust the process of staying in. And then the penalty disappears. And the constraint that said, "Don't touch it," no longer has enforcement. The account that was locked for 30 years suddenly feels like a savings account you've been denied access to. Psychologists call this mental accounting money that was previously categorized as untouchable gets recategorized as accessible, and accessible money gets spent differently. The discipline didn't leave. The frame changed. Now combine that with what the data shows about retirement timing. According to the 2025 Employee Benefit Research Institute Retirement Confidence Survey, 75% of workers say they plan to work for pay in retirement. Only 29% of retirees actually do. The gap between 75 and 29 is not a survey error. It is a consistent pattern that has shown up in more than 2 decades of annual surveys. The majority of people building their retirement plans are building them with income that will never exist. This matters at 59 specifically because of the external timing risk. The 2026 EBRI Retirement Confidence Survey, published April 2026, found that 46% of those who retired in 2025 stopped working earlier than they planned. And 76% of those early exits were caused by circumstances outside the person's control. Health problems, company restructuring, layoffs, caregiving obligations for a spouse or parent, not a personal choice, a forced exit. A separate EBRI study of 3,600 retirees between 62 and 75 found that 58% retired earlier than they had planned. 58%, that is not a cautionary edge case. That is the typical outcome. So here's the reversal. You think the risk at 59 is making a bad investment decision, but the actual risk is that you won't get to make any decision at all. The company makes it for you. Your body makes it for you. And suddenly you find yourself at 60 with 5 years to go before Medicare, 2 years before you plan to claim Social Security, and a 401k that was designed as a bridge to supplement your income, not as your only income. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Here is where I want to introduce someone I'll call Mark. Mark is 59 years old. He has $750,000 in a 401k. He is healthy, no major debts. His plan, the one he built mentally since he was 40, is to retire at 62. He'll claim Social Security at 62 because the money feels real and certain, and he's been told he can always claim early and switch later. He will spend 3 years bridging the gap between 62 and 65 on his portfolio. He has not modeled his healthcare costs during that gap. He has not modeled what happens to the Ratchet if the market is down in year 1. He doesn't know the ACA subsidy landscape changed at the end of 2025. Mark has done everything right for 30 years. Mark is about to step on 3 landmines simultaneously without knowing any of them are there. We'll come back to Mark. Here is the number I promised you. According to ACA Marketplace data from 2026, a 62-year-old without subsidies pays between $1,000 and $1,800 per month in premiums per person. That is $12,000 to $21,600 per year in premiums alone, before a single doctor's appointment, before deductibles, before prescriptions, before any out-of-pocket cost sharing. Now here is the part that became materially worse at the start of 2026. The enhanced ACA subsidies that were extended through 2025, the ones that reduced premium costs for millions of early retirees, expired at the end of 2025. AARP confirmed in early 2026 that the outcome of efforts in Congress to restore them is uncertain, which means early retirees who are depending on those subsidies to make the numbers work are now looking at a fundamentally different cost structure than the one they planned around. There is a secondary trap embedded inside this trap. If you are withdrawing from a traditional 401k to cover living expenses, which is the situation for most people whose savings are in pre-tax accounts, those withdrawals count as taxable income. Your ACA subsidy eligibility is calculated on your modified adjusted gross income. Pull too much from a traditional account to live, and you cross the income threshold, and your premiums can double or triple immediately. And to pay those higher premiums, you need to withdraw more, which increases your MAGI further, which raises the premiums again. It's a doom loop built simultaneously into the tax code and the insurance market. And it activates specifically because you retired before 65. Fidelity Investments' 2025 retiree healthcare cost estimate projects that the average 65-year-old who retires in 2025 will spend $172,500 on healthcare and medical expenses throughout retirement, not including long-term care costs. Milliman's 2025 data puts the projected lifetime number for a healthy 65-year-old male at approximately $275,000, and for a female who statistically lives longer at $313,000. Those numbers are post-Medicare. If you retire at 59 and spend 6 years paying marketplace premiums before Medicare begins, you are adding a separate 6-figure bill that most retirement projection tools simply do not include. And they don't include it because the tool doesn't know when you're retiring. Here is how this lands on Mark. He retires at 62, not by choice. His division was restructured. He needs income immediately. He takes $40,000 per year from the 401k to cover living expenses. That withdrawal puts his MAGI above the income threshold for meaningful subsidies. His marketplace premium for a single plan is $1,300 per month. That's $15,600 per year, a cost he was not modeling. He needs to withdraw an additional $15,600 just to pay for health insurance, pushing his total annual withdrawal from his portfolio to $55,000. That is 7.3% of his original $750,000 portfolio in year 1. And then the market drops 15%. End of year 1, $750,000. Minus 15% is $637,000. minus $55,000 in withdrawals, Mark is sitting at $582,000. The ratchet has clicked, not once, multiple times. This is where it gets really interesting, because the third converging problem locks everything in permanently. In a few minutes, I'm going to give you the 3-level framework that shows you which of these problems you can still fix and which ones have a closing window. But first, let me show you the move that most people make when everything converges at once, because it feels logical. And it is the most expensive long-term decision in this scenario. They claim Social Security at 62. According to the 2025 EBRI survey, roughly 25% of new Social Security beneficiaries in 2024 claimed at 62, the earliest possible age. And nearly half of all claimants filed before reaching their full retirement age. Claiming at 62 instead of waiting until full retirement age, which is 67 for anyone born in 1960 or later, permanently reduces your monthly benefit by approximately 30%. The Social Security Administration does not give you that money back later. It is not a timing delay. It is a permanent benefit haircut that you carry for every month of the rest of your life. On a $2,000 full monthly benefit, that 30% reduction means $600 less per month, $7,200 per year less. Over a 25-year retirement, that is $180,000 in cumulative lost income. And that's before factoring in the 8% per year delayed retirement credit you forfeit by not waiting until 70. Wait until age 70, and your monthly benefit is roughly 77% higher than what you'd receive at 62. On that same $2,000 full retirement age benefit, the lifetime difference between claiming at 62 versus waiting until 70 runs into 6 figures easily. And because Social Security has cost of living adjustments applied to the base benefit, a higher starting benefit compounds over time into an even larger cumulative difference. But here's the thing about this trap. People don't claim Social Security at 62 because they ran the math and decided it was optimal. They claim because they ran out of other options. The portfolio is declining. The healthcare premium is higher than projected. The paycheck is gone. And a fixed monthly deposit from the Social Security Administration feels like the one certain thing in an increasingly uncertain picture. So they take it, not because it's optimal, because it's available. And when they do, the 3-cycle compression is complete. The sequence risk has damaged the portfolio. The healthcare gap is draining the portfolio further. The Social Security decision means the floor of fixed income is now lower, which means more portfolio withdrawals are required to maintain living standards, which means more Maggie exposure, which means more premium costs, which means the ratchet clicks again. This is a single systemic trap, not 3 separate mistakes. And it activates specifically because the conventional max your 401k and retire at 65 plan was never designed for the reality that half of Americans don't get to 65 on their own timeline. Here's the part that retirement calculators leave out almost by design. Knowing these numbers and building a specific system around them are 2 very different problems. I spent about 18 months digging through 50 years of actual retirement data to understand why certain people navigate this window cleanly while others don't. It comes down to decisions made before the pressure starts, not during it. I built all of that research into a digital book called The Exit Code. It's an 8-chapter analysis of what the historical data actually shows about exiting the workforce successfully. 2 sections are directly relevant to everything in this video. The first is what I call the invisible bill, the insurance gap that costs early retirees an average of $14,000 or more per year before Medicare begins, and the 4 income sequencing strategies that can legally keep your modified adjusted gross income below the premium threshold. The second is the dynamic withdrawal method, a framework that replaces the rigid 4% rule with a system that adjusts based on your portfolio's actual performance, so you're not doing what Mark is doing in year 1 of a down market. The book is built on 50 years of actual retirement data, not opinion. It costs less than dinner out through the link in the description. Now, let me give you the framework that tells you whether you're protected. I call it the 3 levels of exposure at 59. Level 1. You have a sequence of returns plan. You know when you're going to start withdrawing, from which accounts, and in what order. You have a buffer, not a savings account yielding less than inflation, but 1 to 2 years of living expenses in short duration, high quality fixed income instruments. This buffer means you don't have to sell equities in year 1 of a bad market. You draw from the buffer while the portfolio recovers, and you never click the ratchet in the worst circumstances. Level 2, you have a healthcare bridge plan. You know your modified adjusted gross income targets for every year between 59 and 65. You know which account withdrawals count toward MAGI and which ones don't. Roth distributions don't. Taxable brokerage, long-term capital gains often can be managed below certain thresholds. Traditional 401k and IRA withdrawals do count in full. If you've been doing Roth conversions during lower income years in your mid to late 50s, you have a lever that can keep you in subsidy eligible territory or below it entirely during the most expensive healthcare years of your pre-Medicare life. The difference between a $1,200 premium and a $200 premium is $10,000 per year. Over 6 years, that's $60,000. Worth planning for. Level 3, you have a Social Security timing strategy. You know your break-even point against claiming early. You know that the break-even for claiming at 67 versus 62 is typically around age 78. And for age 70 versus 62, it's around age 80, both well within average life expectancy for a healthy person reaching 60. You have a bridge plan, a specific framework using portfolio assets to cover living expenses from the date of retirement until age 70, designed to avoid triggering sequence risk or MAGI problems in the process. This is called the Social Security Bridge Strategy, and it is the counterintuitive answer to the problem of claiming early out of panic. If you have all three, you can retire at 59 or 60 with a high probability of preserving the retirement you planned. If you have 0 out of 3, which describes most people I talk to, you are Mark. Sir, your financial plan says you'll work until 65. Right. Your company eliminated your position at 59. Right. But the plan says 65. I know. I need the market to cooperate. The market is down 18%. I'm aware, and you've already claimed Social Security. It felt like the right time. The average retirement age in America is 62. The average expected retirement age among workers is 65. That 3-year gap has been consistent for more than 2 decades across multiple independent surveys. And yet, the retirement planning industry spends most of its energy optimizing for 65 because that's where the Medicare eligibility is. That's where the full Social Security benefit is. That's where the plan looks clean on paper. The data says half the people watching this won't get there. And there's something worth noting about the people who do navigate 59 well. It is almost never because they had more money. It is because they understood what the window actually demands. Wade Pfau and Kitces describe the retirement risk zone as a period when 3 forces converge simultaneously. The portfolio is at its largest absolute size. Withdrawals have just begun, and the investor has the least amount of remaining time to recover from a bad sequence. A market downturn in this window does proportionally more damage than the same downturn at any other point in the life cycle. The 2000 cohort of retirees illustrates this with painful clarity. Those who retired in 2000 faced the dot-com crash, a 49% drawdown in the S&P 500 between 2000 and 2002. Then, before full recovery, they faced the 2008 financial crisis, a 57% drawdown. Research from the Arca Labs found that a 4% inflation-adjusted withdrawal strategy left the 2000 cohort with roughly 60% less wealth by 2010 than the same strategy delivered to the 1990 cohort, despite similar long-run average market returns. 2 devastating bear markets inside the critical first decade. The ratchet clicked over and over at maximum portfolio size, with no mechanism to unclick it. Now, back to Mark. Mark is in year 3. His portfolio sits at approximately $500,000. The market has partially recovered. His Social Security claim of $1,400 per month helps, but it's not enough to stop the withdrawals from the 401k. He's down to $490,000 by end of year 3, with 1 year remaining before Medicare. He makes it. But the retirement he has is not the retirement he planned. The travel is local. The gifting is modest. The margin for error is thin. The alternate Mark spent 3 years from 56 to 59 doing disciplined Roth conversions during years when his income was lower. He converted enough that his early retirement MAGI stays in a range that qualifies him for meaningful subsidy. His healthcare premium is under $250 per month for a solid silver plan. He built a 2-year bond ladder that gives him breathing room if the market dips in years 1 or 2. He delays Social Security to 67, bridging the gap using Roth distributions that don't count toward MAGI. At 65, when Medicare kicks in, his 401k is materially less depleted than the first Mark's, and his Social Security check is 30% higher for life. Same salary history, same savings rate, same starting amount at 59. Completely different architecture, completely different retirement. The point is not that most people fail. The point is that failure at this stage is almost never random. It follows a predictable pattern of 3 converging problems, all of which activate around 59, all of which are addressable with pre-window planning, and none of which show up in a standard retirement projection because standard projections don't model the involuntary exit. Somewhere right now, a financial advisor is showing a client a projection that assumes 6% average annual returns, clean retirement at 65, healthcare costs vaguely covered by Medicare, plus some supplement, and Social Security at full retirement age. The line curves gently down to 0 at age 93. It looks like a plan. It accounts for inflation. It is technically competent and practically useless for the actual retirement that data suggests is likely. Looks solid, says the client. Very solid, says the advisor, who charges 1% of assets annually to produce it. Neither of them has modeled a market drawdown in year 1. Neither of them has modeled a forced exit at 59. The plan is perfect for the retirement nobody actually has. Let me leave you with 3 things calibrated specifically to the 59 trap, not generic retirement advice that applies to everyone and therefore to no one. First, run the involuntary retirement scenario right now. Take your current financial plan, whatever form it exists in, and stress test what happens if you are forced out of work 3 years before your target retirement date in the first year of a 15% market decline. If the answer is portfolio collapse or permanent lifestyle reduction, you have a structural problem to solve now. This is not pessimism. According to the 2026 EBRI survey, 46% of people who retired in 2025 did not choose the timing. Half the people in this window don't get to choose. Plan for the retirement that happens, not only the one you want. Second, map your modified adjusted gross income for every year between now and 65. Identify which of your assets generate MAGI counting income on withdrawal and which ones don't. If the majority of your retirement wealth is in traditional pre-tax accounts, you have a healthcare premium problem you haven't priced in yet. Roth conversions done before 59 during lower income years while you're still contributing are the primary tool for managing MAGI during the healthcare gap. The math on this is not subtle. The difference between $400 a month and $1,400 a month in premiums is $12,000 per year. Over 6 years, that is $72,000 pre-tax. Third, build a 2-year buffer before you need it, and build it in the right instrument. Not a savings account that yields less than inflation. Not in your equity portfolio where it has to be sold in a down market. In short duration, high quality fixed income treasury instruments, short bond ladders that give you the ability to go 24 months without selling a single equity position. That 2-year buffer is the single structural tool that most clearly separates the people who emerge from the first bear market of retirement intact from the people who ratchet down permanently. It is not a sacrifice of returns. Over a 30-year retirement, the cost of holding that buffer is minimal. The cost of not holding it during a year 1 drawdown can be measured in decades of compound growth that never happens. The trap at 59 is real. The math is precise, and the system was designed to get you contributing for decades, not to protect you in the window where it matters most. Lazy investing built more fortune than crypto memes. And the people who understood that earliest weren't the ones chasing the hottest hand. They were the ones who built the architecture before the valve opened and didn't let the feeling of arrival make them stop